Did you know that India and China have emerged as the primary buyers of Russia's oil in April, defying the Western attempts to limit Russia's military operations in Ukraine through a price cap? Despite the Western-imposed restriction of $60 per barrel, traders' calculations reveal that India and China are acquiring Russian oil at prices exceeding the Western price limit. This situation has allowed Russia to continue generating substantial revenues, indicating a strategic shift in the global oil market. Even though certain European Union countries are pushing for a decrease in the price cap to increase pressure on Moscow, a G7 source has confirmed that the cap will remain unchanged, signifying the complexities of international relations and the geopolitical landscape. The strategic master plan of China and India to counter Western sanctions is believed to have significant implications, potentially altering the dynamics of the geopolitical landscape. The recent ban by the European Union on Russia's oil product exports has prompted Russia to reduce its crude oil production by 500,000 barrels per day, a substantial 5% of its total volume, starting from March. Analysts suggest that these new restrictions pose a greater challenge for Russia compared to previous situations, as finding new markets for oil products proves to be more arduous than crude oil. This limitation forces Russia to rely on countries like China and India, which can process crude oil domestically, generating additional revenue. In response to the Western-imposed price cap restrictions, Moscow has made it clear that it will not engage in business with any country that incorporates the G7 price limit into its deals. Consequently, two distinct global oil markets have emerged: one where China and India purchase cheap Russian oil, and another where Russian oil is absent due to sanctions. This division showcases the geopolitical struggles and the intricate balance of power between Russia and the Western countries. Despite selling more oil to Asia, Russia experienced a significant decline of 50% in oil and gas revenues in 2022 compared to the previous year. To compensate for the loss, Russia had to sell off its foreign currency reserves, indicating the economic challenges it faces under sanctions. The new price cap system, coupled with logistical challenges, is expected to further impact oil prices and revenue for Russia. The pressure exerted by the EU, G7, and the US could further exacerbate the decline in Russia's oil and gas revenues this year, necessitating the exploration of alternative sources of income. Experts anticipate that there will be strong demand for Russian energy from China and India in 2023, with Chinese buyers demonstrating more interest in Russian crude than their Indian counterparts. This indicates the evolving energy dynamics in the region and the strategic importance of Russian energy resources. Consequently, Russian crude exports may need to increase if there are challenges in finding new markets for distillate exports due to the EU's ban on Russian products. While the G7's price cap system has been deemed effective, market fluctuations may still influence Russia's discounts compared to global prices. Traders report that Urals, a type of Russian crude oil, typically receives discounts of $13 per barrel when shipped to Indian ports and $9 per barrel when shipped to Chinese ports on a delivered ex-ship basis. These discounts reflect the complex negotiations and bargaining power between buyers and sellers in the global oil market. Freight costs for delivering Urals crude oil to India and China have recently decreased due to improved Russian port ice conditions and increased availability of tankers. These cost reductions signify the efforts to streamline logistics and enhance efficiency in the transportation of Russian oil. However, geopolitical tensions and the output cuts announced by OPEC+ in April have resulted in a rise in prices for different types of oil, including Urals, on a global scale. These market dynamics demonstrate the interconnectedness of the global oil market and the impact of various factors on oil prices. China and India's significant imports of Russian crude oil indicate the impact of Western sanctions on Russia's oil-dependent economy. Despite the punitive measures imposed by Western countries in response to the conflict in Ukraine, Russia's economy has fared reasonably well, primarily due to the high demand for Russian energy from China and India. By not participating in the sanctions or condemning Russia's actions, these two countries have provided crucial stability to Russia's energy sector. China, in particular, has become the second-largest supplier of crude oil to Russia, solidifying their bilateral ties. Moreover, China's imports of pipeline gas and liquefied natural gas from Russia increased by 2.6 times and 2.4 times respectively in 2022, indicating the growing energy partnership between the two nations. Similarly, India has become the largest customer of Russian oil, with record-breaking imports of 1.4 million barrels per day in January 2023. Additionally, India's thermal coal imports grew by nearly 15% in 2022, further cementing the energy ties between the two countries. Prime Minister Narendra Modi of India faces a challenging decision as he navigates high inflation and an upcoming election year. While he has strengthened ties with Western countries, he continues to maintain a strong relationship with Russia. However, analysts believe that the allure of cheap imports from other countries might tempt India to diversify its energy sources. Turkey has already emerged as a major buyer of Russian crude oil and coal, and predictions indicate that Pakistan and Bangladesh may follow suit by increasing their imports of Russian energy at lower prices. In conclusion, the evolving dynamics in the global oil market reflect the strategic choices made by Russia, China, and India amidst Western sanctions. The significant purchases of Russian oil by India and China have provided a degree of economic stability for Russia, despite efforts to limit its military actions in Ukraine. The intricate interplay between energy demands, sanctions, and strategic partnerships continues to shape the dynamics of the global oil market, while geopolitical complexities further complicate the landscape. As the world observes these developments, the future of the global oil market remains uncertain, with ongoing implications for the economies and geopolitical relations of the involved nations.